Recording in progress.
Hi everyone, welcome back to the channel. So as of now, we have discussed about capital asset pricing model and other measures which includes Treynor ratio, Sharpe ratio, standard deviation, alpha, beta, and systematic and unsystematic risk. And apart from that, market risk premium, market returns, expected returns, risk-free rate. So now we are okay. Let's just do a quick recap of what we have discussed. So we have discussed majorly about beta, and this is what our objective was. So capital asset pricing model, it's incomplete without beta, and the meaning of beta is actually a measure to calculate the systematic risk. There are two types of risk. There are systematic and unsystematic risk. We have discussed previously that systematic risk can be cannot be diversified. This cannot be cannot be diversified, and this is related to economy. And unsystematic risk is the risk which can be diversified. This is related to company specific, and systematic risk is measured using beta, and also uh, total risk is systematic plus unsystematic risk. And when we look at the capital asset pricing model, so capital asset pricing model, the formula, let me just show you the formula, this part. This part here, it's measuring the systematic risk, and here we are just talking about the unsystematic risk. Government T-bill rate is the risk-free rate, and how much more we are making given the sensitivity of the stock with the market, which is represented by beta. That's the expected return. Okay, so let's just do a recap. So if the beta is equals to 1, this means it's the market volatility is same as the market volatility. The market volatility means the stock and the stock and the market have the same volatility. If the beta is greater than 1, this means that it's more volatile than the market, it's riskier. And if it's the more the risk, the more the return. If beta is less than 1, this means it's less volatile and the risk is also less. Uh, if you remember, we did example number 3. Okay, not example number 3, but example number 2. So comparing two scores, if the beta is 0.8 and 0 beta is 1.3, because it's a multiplying factor actually. So it's actually influencing the total output. So it's the lesser the beta, the lesser the return. The more the beta, the more the return. And if the beta is equal to 0, so there are no market risk. This means the T we can say that it's a T bill, treasury bill, government security. And yes, for a government security, that the risk-free rate is equals to whatsoever be the risk-free rate, but the beta for government security is always 0. And when we talk about when beta is less than zero, this means the relationship between the stock and the market, it's negative in nature. This means if one goes up, the another goes down. If another goes up, the other goes down. So this means a negative relationship, and they move in a opposite direction to the market. And this is very rare. And finding these kind of securities, uh, previously these kind of securities were used to hedge their portfolios. So when we are discussing about it, let's discuss for a moment about uh, what negative beta means. So we are discussing about negative beta. So beta actually measures how a stock moves related to the market benchmark, which is a broader index like S&P 500, S&P 500, or Nifty 50 in India, Nifty 50 in India, or Sensex. A negative beta implies an inverse correlation. When the market goes up, the stock tends to fall. When the market falls, the stock may rise. And because of this inverse relationship, negative beta assets are often viewed as hedges or portfolio diversifiers. And they are actually useful, especially in volatile or bearish periods. In volatile and bearish periods, these negative beta stocks are actually very helpful. And yes, a beta of a stock can be negative. Anything is possible in the world of finance. But negative beta is very rare, and most listed stocks show a positive beta, or at least low but positive beta. If we talk about examples, negative beta examples, because negative beta are rare and most examples come from United States markets or niche or defensive companies. Some recent listed examples on the internet, which I was able to find out, were about first, it was about TK company, TK Corporation. Uh, the other one was about Walk Me Limited, and several small or niche companies according to a screening list of negative beta stocks. So many of these are not mainstream or large cap companies. These are not large cap names. The reality of a negative beta makes such kind of companies exception than norm, and also contrary to what some might think or some might expect. It's really hard to find recent or publicly discussed examples of reliable negative beta stocks that remain negative today also. Many negative beta list changes frequently and often include smaller, volatile, or distressed companies. So if the beta of a company is negative, so they might be smaller, volatile, or distressed companies. So that is one possibility for a company to have a negative beta. And uh, an alternative, because negative beta stocks are very rare, many investors rely on alternative asset classes that op that actually approximate negative beta behavior, and these includes when we are creating a portfolio. I'm talking about the perspective of a portfolio. So to diversify, to hedge our risk, uh, investors usually use precious metals or commodities. Example is gold. Usually have gold in their portfolio, do keep gold in their portfolio for hedging purposes, because previously it has been noticed that when all the market goes down, whenever the market falls down, the commodities market actually goes up. And there are different reasons. We will discuss about the logic in a while. Just give me a moment. Let me just complete what I have just finished. So, portfolio from a portfolio's perspective, securities or the asset class, which is alternative to negative beta, is first precious metal and other financial instruments like derivatives. When we talk about derivatives, uh, or hedge funds or mutual funds also. So these are the asset classes which replicate uh, a negative beta somehow. Uh, so negative beta, if you've heard about any of these securities, so you know that any of these instruments, so you know that these are done to hedge their risk, hedge risk. Mm. And why it's really fine, it's very difficult to find negative beta, and especially in India, is because negative beta is rare by nature. Most companies operate in cycles linked to economy or market and giving them positive correlation with the overall market. So first of all, the Indian economy, if we are looking at the examples, these are the US examples only, US examples from a mature country, from a developed nation, developed country, developed nation. And it's very difficult to find these kind of companies with negative beta in India because uh, see, most of the companies operate in cycles in India, and those cycles are actually linked with the economy and the market. And given this actually gives them a positive correlation with the market. In Indian market, a lot of analysis around beta involves low beta rather than truly negative. So the stock are sensitive to the market, but they are actually lesser sensitive. So less sensitive. That's why the return are also less in the market because uh, rather than being negative, they are low betas. And list of low beta stocks in India tend to include stable blue chip and defensive companies, but that doesn't mean their beta is negative. And because of these all factors, many of the negative beta examples you will find are from United States of international markets, but not Indian stocks. And why? Uh, just remember this thing that the Indian business cycles or operate Indian companies actually operate. Uh, I mean, the operational cycles are actually linked to economy or market. But these kind of companies with negative beta are common, and those not common but can be found because these are rare. So these can be found in United States or in developed nations. And my view is that because negative beta stocks are rare, the most publicly available beta stock list in India, they show low but positive beta, and you probably should not expect many reliable negative beta company or beta picks in beta companies in Indian equity market. If you want a market hedging exposure, you might instead consider gold or gold related instruments like ETF, exchange traded funds, sovereign gold bonds, which are long used as a hedge during equity downturns, or a mix of low beta but fundamentally stable companies, plus growth oriented companies to diversify the risk. So to diversify the risk, you can use less volatile companies and high volatile companies. So you can diversify the risk. This could be one approach, and alternative assets also like commodities. You can use commodities, or one thing which we did not discuss about is debt also. the government debt securities or the corporate debt securities, which are now available on the stock, which are also traded as ETFs. So if you want to diversify, you can actually look into those things also. So alternative assets, global stocks with different correlations. Uh, that depends on if you have access to the international markets. So I hope this actually was clear because we have discussed about negative beta in detail now, and we have covered everything which should be from an introduction perspective. You should know. Okay, so we have discussed this thing. Let's understand one more thing. Assumptions of capital asset pricing model. What does capital asset pricing model assumes? And the strengths and limitations of capital asset pricing model. So let me just clean up my board first. So, okay, so assumptions of capital market pricing model are that it relies on several assumptions. Investors hold diversified portfolios, markets are efficient, no taxes or transaction cost. Investors care only about mean and variance of returns. All investors can borrow, lend at the risk-free rate. And these assumptions make capital asset pricing model simple but unrealistic in real markets because they do not factor in about the diversification of portfolios. They do not factor in, I mean, markets could be efficient or markets could not be efficient. They do not talk about the taxes, and they only talk whether they only care whether the investor is only uh, concerned about the mean and the variance of returns. And capital asset pricing model assumes that investors can borrow and lend at a risk-free rate. So these are the assumptions made in capital asset pricing model, and that's why capital asset pricing models is simple, but it's unrealistic in real markets. The strengths and limitations are that the advantages is that it's easy to compute, widely used in corporate finance, WACC, weighted average cost of capital, and valuations, provides a benchmark return. But the limitations is that the beta is based on the historical data, may not represent the future risk. Yes, this is a limitation of capital asset pricing model. If you think about it, okay, just remember whatsoever we are reading or whatsoever we are learning here. So there is a practical approach and there is a theoretical approach. So in theory, pardon my spelling, in theory and in practice, so these are both different things. Just remember this thing. So we just want you to, I just want you to understand the concept here. Yes, we do apply capital asset pricing model. At a lot of times, you will see that we work around capital asset pricing model, but we do not rely 100% on capital asset pricing model. And because of these factors, just remember the advantage and disadvantages of capital asset pricing model. It's easy to compute, widely used in corporate finance, yes. Provides a benchmark return, yes. Limitation is that it is based on historical data. So, whatsoever was the trend in history, you cannot use historical numbers to represent the future risk. So, you cannot assume that previously the risk was 10%, in future also the risk is going to be 10% only. So, you cannot, it's a limitation of capital asset pricing model. The another limitation is that the real markets are not perfectly efficient. And yes, this is true. Real markets are not perfectly efficient. Efficient markets means they are highly efficient, high, weak, and low efficient markets. So efficiency shows about the information about the stock or the market, how much the information is incorporated. Information is incorporated in the valuation of the stock. If all the information is incorporated, it's a highly efficient market. If some of the information is incorporated, it's weakly efficient. And if none of it's very low information is incorporated in the market, the what people are saying and all other factors are looked into. So this is about the efficiency. So this represents the efficiency. So real markets are not perfectly efficient because there are some information which is proprietary and it's only with the insiders of the company. So real markets are not perfectly efficient and assumes risk is captured only by beta and ignores other factors. Yes, this is what I just talked about in the above point. So it assumes that the risk is captured only by beta and ignores the other factors. And if you look at the market, so if we do any kind of valuation, we calculate, let's say the stock's price is $100 or 100 rupees. But when you will go to the market and check the current price of the stock, so it would not be $100. It would not be exactly $100. Maybe it's around. Maybe it's way too much above. Maybe it's way too much down. Your $100 as valuation, and this is because of the efficiency of the market. Assumes risk is captured only on beta, ignores other factors. So these three are the limitations of capital asset pricing model, and you need to know these kind of things when you are doing valuation in practice or in practical in market in real life. When you're doing a valuation, you need to look at the other factors also. And the final word here is that capital states that capital asset pricing model states that the expected return of an asset equals to the risk-free rate plus compensation for its systematic risk, which is beta RM minus RF. This one, this is the risk-free rate. We add this. It's a foundational concept in finance used in valuation, portfolio management, and performance measures. I hope this was clear. Uh, okay, so let's move to the other part, which is uh, before doing, okay, we have question and answers below this. We will do question and answers later on. But before that, I actually wanted to discuss about the other measures. So, so I'm going to just talk about these other measures very briefly so that you get an idea. And it's only about it's only about, we will be discussing only the concept. We will not be going in detail into the concept right now. Okay. Okay. So let's start. So these other measures are for portfolio creations and the return measures. Security market line. So security market line is actually a graphical presentation of the capital asset pricing equation. It plots expected return versus beta. So this is the beta and this is the expected return. And this line is the security market line. And see here, it doesn't start from zero. It starts from the three because this much is the risk-free rate. This much is the risk-free rate. This is the security market line. If the stock lies above this thing, it's undervalued. If the stock lies here, it's overvalued. Understand the diagram. So the key feature is x-axis is the beta, y-axis is the expected return. The slope is the market risk premium, which is represented by RM minus RF. RM minus RF. If you remember, market risk premium is RM minus RF. It shows whether a security is overvalued or undervalued, and the purpose is that it's used to evaluate if the security lies above or below the securities market line. Okay, so let's talk about capital asset pricing model. Capital asset pricing model, we have discussed about it in detail. So this model computes the return, the required return of an asset based on its systematic risk, which is beta. The formula is the risk-free rate plus beta RM minus RF, which is the this portion is the market risk premium. And it uses the key feature is that it uses beta risk-free rate and the market return, converts risk into expected rate of return, assumes investors are compensated only for systematic risk, which is market risk. The purpose is to calculate the required return and it's used in weighted average cost of capital, valuation, and portfolio analysis. And if you look at the diagram here, so this is the risk-free rate. The risk-free rate starts from here, not from it's not also starting from origin. This is the market return. This much is the market return. The risk premium between 3 to 9%, let's assume. So this one is the market return, and the risk rate is normally taken as the yield of the long-term government bond on the country where the project or the company is based. So this is also representing the beta. The x-axis is representing beta here also in the capital asset pricing model. When we look at the graphical representation. Now, let's uh, uh, okay, let's talk about capital market line, CML. So the CML is a line describing portfolio. So it's about the portfolios. When we discuss about portfolio, we talk about capital market line. And again, the x-axis here does not represent only beta. It represents the total risk, which is the standard deviation of the which is the standard deviation, and y is the expected return here also and here also. The slope of this capital market line is uh, it represents the Sharpe ratio. And if you remember, Sharpe ratio is our it actually measures return per unit of total risk. And the Sharpe ratio formula was RP minus RF upon sigma portfolio. It only applies to efficient portfolios, not individual securities. So you need to understand this thing. When we are talking about security market line, we it only applies to efficient portfolios, not individual securities. And the purpose is to show best possible risk combinations used for portfolio optimization. When we discuss about portfolio, we will discuss about CML in detail, capital market line, and it's a very good topic, very practical. Beta, we have discussed. It's a measure of systematic risk, how much an asset moves relative to the market. Beta 1 means it moves with the market. Beta less than 1 means it's more volatile. Beta is greater than 1 means more volatile, less than 1 means less volatile. Beta is less than 0 moves opposite to the direction. This means it's negatively related. And alpha is something, okay, we have discussed about beta. Now let's talk about alpha. So alpha is a performance relative to capital expenditure. Oh, sorry, capital asset pricing model expectations. So let's assume the actual return was 15% and our expected capital asset CAPM expected return, we were expecting 10% of the return. So this 5% is actually the alpha. The alpha means the performance related to capital asset pricing model expectations. So how much above the capital asset pricing model we have generated, that's the alpha. So if the alpha is greater than zero, we have outperformed the market. If the alpha is less than zero, we have underperformed the market. And it's used in evaluating the fund managers. And evaluation of the fund managers is used by alpha. The purpose is to measure skills and abnormal return, and it's used in active portfolio management. Sharpe ratio, it measures excess return you earn per unit of total risk, RP minus RF upon sigma P. And this is, we just